People look for the fancy stuff. They look for the flashy stuff. They want to see the thing that makes them believe that they can do this with little to no effort and the imaginary get rich quick thing, so to speak. But I really like some of the things you were talking about as a lifestyle where I think people get a few things wrong. First off, what you were talking about is chasing these returns from people that are over promising them an unrealistic return or an unrealistic profit share, where long term over the years, if you look for just the lower thing that's more consistent, you will see that that will beat it. I give the example of the guy who leads the league in home runs every year, also leads the league in strikeouts. And I've
Hmm.
heard you really not chase the fancy, sexy thing, but chase the stable thing and look for the things that you don't need lose money. So I like to start with that for somebody listening. Talk about how to create a lifestyle that you don't have to go after these big wins and these home runs to really move the needle and get a better quality of life.
Yeah, well, really, what I want to do is I want to model after what the wealthiest people in the world do. And I've got data on this. I mean, this is what I dig into all the time. So, if you look at single family office data, so a family office is a group that basically runs and manages the wealth for high net worth individuals. A single family office generally is the group that manages money for billionaires. And then you've got a multifamily office that's going to manage money often for, decamillionaires, centimillionaires. There are different levels of wealth. So I want to look at who are the top people. And I have an exhaustive amount of data from these groups. And I think that mistake that a lot of people make is they swing for the fences with all of their assets. They want the best return, but that's an easy way to also lose all your money. And so for me, my goal isn't to make the best return. My goal is to not lose money and make a good return, right? So those are totally different than like, I want to get a 30% return or a 25% IRR. Hey, I would love that. I would love for that to happen periodically, and it does, but the underwriting that I would do needs to tell me that it's a safer, more secure deal, and I shouldn't be having those returns all the time. So what do the wealthy do? If you look at any of these single family offices, any of these billionaires, they generally only have about 15 to 25% of their net worth in the stock market. All right. So that's one thing most people don't realize. Most people think that it's the majority of their net worth. They also think that they made their money in the stock market, and they didn't. They made their money in alternative investments and then put a portion of it into the stock market, or they made their money, with a business exit, right? Well, then you've got the largest percentage, 20 to 30%, sometimes even as high as 35% in private equity, right? So not publicly listed companies, private companies. You've got another, really probably 10 to 20%, maybe even as high as 25% in real estate from these wealthy individuals. You got another 5 to 10, maybe even high as 15% in private credit. So, bonds would be public debt and private debt vehicles would be private credit, right? And so generally the wealthiest people have about 50 to 60% of their net worth in alternative investments. And Wall Street's done this brilliant job of actually teaching people that, oh no, these are just alternative investments, alternative to the stock market. But the wealthiest people, that is their primary investment, and the stock market is the alternative investment. And by the way, most of the reason that the wealthy have money in the stock market isn't for the returns that they get. It's that it's a liquid pile of money that they can borrow against to then go buy more alternative investments. Because if they don't sell the stock and they just borrow against it, there's no capital gain. There's no taxable event. And so, I love teaching people these sorts of things. And when you understand that, you're not trying to max out every return. You're trying to say, hey, well, over here in private credit, you're probably going to earn about 10%. Over here in fixed income, which is about 5 to 10% of these billionaires' net worth, you're going to earn probably 4 to 5%. Over here in real estate, you're probably targeting 15 to 20% IRRs. You're happy with 15. You're even happier if it's more, but you'd rather take a sure thing than swing for the fences. For the percentage that is high risk, like early stage seed type of investing, it's only about 1% max of net worth that these billionaires put money into the early stage. And if you look at venture capital, which is a huge buzzword and interesting investment class, that's usually only 4 to 10%, in the Series A, Series B, that type of stage. So the high risk stuff is very minimal and the low risk stuff is much greater.